name is Amit. This is the 14th lecture of auditing, and today we are going to start with chapter 2, checking, vouching, and audit report. This chapter contains test checking, what is meant by voucher, how the vouching is done, then vouching for cash book, how the audit report is prepared, what are its attributes, then how the audit certificate is issued by the auditors, then auditing and assurance standards, then any questions for discussions, and then previous university examination points are also given. What are we going to learn in this? To study the concepts of test checking and vouching of cash book, to learn the verification and valuation of assets and liabilities, to understand the various types of audit reports, then to be able to explain the meaning of audit certificate, to differentiate between audit report and audit certificate, to elaborate the auditing and assurance standards. This is the purpose of chapter 2. These are the objectives we are going to learn in this chapter. Before we start off with this second chapter, I would like you to understand the meaning of certain concepts. Voucher. It's a documentary evidence supporting a business transaction. So I have been mentioning about voucher, preparation of voucher, checking of voucher. Now we are going to see what actually the voucher is. It's just a documentary evidence for some financial transaction or non-financial transaction as well. Second is test check. It is the examination of few transactions of a business instead of checking all transactions. So as I had mentioned to you about the audit scope earlier, the auditor may, if they are okay with the internal control system, if they are satisfied that the internal control system is good, they do test checking, they do sample checking. This sample checking is nothing but this test checking. Then vouching. It's an act of substantiating an entry in the books of accounts with the help of a voucher. Now, while checking the voucher, the auditors will also check whether the financial accounting entry of for that particular voucher has been booked in the system or not. That checking is called as vouching. Then preliminary expenses. All the expenses relating to the formation of an enterprise are called preliminary expenses. So whatever expenses the company makes before the certificate of incorporation is issued to them, all such expenses are called as preliminary expenses. Amortization, writing of an asset or expense to profit and loss account. To amortize means to write off. It could be that 100% amortization would be there. So whatever the asset is taken straight away is taken to the P&L instead of keeping that in balance sheet in the asset side and then claiming depreciation on that. The entire asset would be expensed out. Audit report, it's a report prepared by the auditor expressing his or her opinion concerning the assertions made by management after examination of the situation. So it talks about all the observations. It gives facts about the financial position of the organization. We have already seen what are the points that are to be covered in the audit report. Audit certificate, it's a written confirmation issued under the signature of an authorized person of the accuracy of the facts stated in the certificate. And disclaimer or opinion, it is an auditor. If an auditor is unable to obtain sufficient appropriate evidence on a matter which is important, then he or she issues a disclaimer opinion. So they mention that whatever we have checked so far, this is my opinion, this is my observation, this is the disclaimer. Or if they were not able to check anything at all for a particular function, they will mention as disclaimer as due to insufficient data provided by the client, we were not able to check certain things. So that's a disclaimer or opinion. Now we will go to the next thing. Now we will start with the test checking part. If the internal check system of the organization is satisfactory and accounting system are effective, then the auditor need not check each and every transaction. Rather, he can take a sample of the transaction and review it. The opinion of the auditor is formed for the sample transactions and is then extended to the whole population. So, as I mentioned earlier in this lecture itself and during explanation of the first chapter, if the internal check system, internal control system is good, and if the auditors are satisfied with the correctness of it, then they do not have to check all the transactions. They will have some test checking done on a sample basis, and then they form an opinion. And whatever their opinion is, they will form their opinion about the entire volume by doing the test check only. Now, internal checking is defined by MIGS as a means to select and examine a representative sample from a large number of similar items. So, it's a way of checking from the entire sample. They select some from the entire population or from the entire volume. They select few instances as sample and then they check it. So, that's a test checking. Now, what are the safeguards for application of test checking? Test checking should be carried out intelligently and carefully, otherwise, it may lead to dangerous consequences. I had mentioned to you that if the auditor fails to have the correct sample size selection, if the correct sample size selection fails, then it is possible that whatever the frauds that are already happening or whatever errors are already there in the system would get neglected. So auditor has to be intelligent enough to carry out the samples or draw some samples for test checking. Now, for that, the safeguards are: the first is representative. Transactions from all the books and of all the clerks should be included in the sample. So, it should represent the entire volume. The samples that are selected for test checking should represent the entire volume. So, it should not happen like the auditors have selected for a specific person only. It should be if let's say there are four people working in the department, then the sample size should consider the entries for four of them, some entries for four of them, and they should not consider only on one person. The selection of sample should be random. As I had mentioned to you earlier, that nowadays there are softwares that are being used by the big organizations, big CA firms. They have their softwares of random sampling, and they put the entire data into that sampling tool, and then the tool itself gives the samples. The tool itself draws some samples from the volume, and those are checked by the auditors. So nowadays it is the software which takes care of the population sampling. Then complete examination. When auditors do a test, when the auditors perform audit on the basis of test checking, then all the samples that are selected for test checking should be checked right from scratch till its final effect in the balance sheet and P&L account. They should not leave any stone unturned while they do the test checking. It has to be then 100% audit of the selected samples. Complete coverage. The selection of transactions should be made in such a way that over a span of 4 to 5 years, all the transactions come under the review of the auditor. I would differ with this point because the audit is done for a specific period, that is the financial period, which is of 12 months. So most of the times the samples that are going to get selected would be having its effect only for 1 year. So majority the samples that would get selected would fall under the 1 year period, 1 year financial period. Study the processing. The selected transactions should be studied in detail from the beginning till the end, as I mentioned, right from scratch till its end. So right from preparation of the voucher till the balance sheet entry or the P&L final P&L entry, the audit has to be carried out for the samples. Extent of test checking. The use and extent of test checking is dependent on the system of internal check in operation for the business. More efficient the internal check system, lesser the extent of test checking. So if during the test checking, if the auditors feel that out of 10 selected samples, 3 are incorrect, that means they will say that out of all the transactions, 30% of the transactions are not correct. That's how they will check. So that's how they will provide their observation in the audit report. So the extent of audit checking has to be clear, and it should be efficient, and the efficient internal checks should be done by the auditors. Size of sample size can be determined with the help of statistical tools. After determining the confidence level, precision level, and tolerable error required by the auditor. Now, confidence level and precision level, it comes from the volume of transactions they are auditing. So let's say 1 lakh transactions are coming under the total volume. Out of those 1 lakh transactions, auditors will select only 100. Now those 100 should represent the entire volume and it should be drawn in such a manner that high value items, high risk items, then very low value items should get covered. It should not be like auditing is done only for only high value items. It should select the statistical tool should select the samples accordingly. Then tolerable level is nothing but, it is possible that, let's say, if the audit is going on for the inventory. Now, if the inventory has chemicals in it, it is possible that during the course of during the transit, there is a possibility, or the normal loss that is expected in case of that chemical is 5% evaporation. So if, or 10% evaporation, let's say. So if 100 liter of chemical is being transported, it is possible that 10 liter will get evaporated, and that's a normal loss. Though the people who have, the students who have, who are studying the cost accounting as well, they would understand what is a normal loss. So auditors, while setting up tolerance limit in their tool for checking the inventory, they would say, okay, 10% we will accept. Anything beyond 10%, any discrepancy beyond 10% will lead to observation in the audit report. Materiality level. The auditor should set a materiality level to discover the error. Now, when I say tolerance level, it is more related to the quantity. And when I talk about materiality level, it is about the amount. So, on an average, if the transactions in sales are having value, on an average, every sale invoice is on an average having the sale of 5 lakh rupees. Now, that's the normal business and that's average price. Now, if the auditor sets that 5 lakh rupees as materiality level, so anything above normal or anything below normal would be considered by the statistical tool as part of the test check. Now let us look at the difference between the test checking and routine checking. First point of differentiation is concept. Test checking involves the examination of few transactions selected by the auditors, whereas in case of routine checking, it involves the checking of books and records. It doesn't matter the how much is the number of transactions, it is the entire books and records that auditor will check. Object of test checking is to form an opinion on the basis of the conclusions drawn by the examination of few selected transactions. Whereas in case of routine checking, the object is to ensure arithmetical accuracy of the entries in the original books and ledgers and posting to correct ledger account. So in case of routine checking, mostly the error by principal, error by commission are checked by the auditors. Whereas in case of test checking, it is the checking done for, it is the checking right from scratch till end result for all the samples selected for checking. Relationship is the third point of differentiation. Test checking may be the best for routine checking. Yes, but in case of routine checks, it may be performed on the basis of test checking. Then the next important point is voucher. Now, what is a voucher? It's a receipt of money or any document that supports an accounting entry in the books of account. It is a documentary evidence in support of a transaction in the books of accounts. So, as I have been mentioning right from first lecture of auditing, that voucher has to be prepared for any accounting transaction. It could be possible that sales are being booked on the basis of sales invoice, purchases are being booked on the basis of the vendor invoices. But in case of provisions, in case of accruals, in case of depreciation, in case of wages payment of wages, uh, the vouchers are prepared by the organization and the accounting entry should be checked on the basis of vouchers. Now the vouchers are supposed to be signed by different people. One who prepares the voucher, second one who has actually expended that money, and third is the checker. And that checker has to ensure that whatever amounts, whatever details that are written on the voucher are accurate and shows the correct picture of the transaction. The voucher may include a receipt or a counterfile of a receipt. Now let us say if I want to book an accounting entry for payment by check, then for me the voucher would be the counterfile of the checkbook. So the small part of the entire counterfile, big part we submit with the check and the small part remains with us. That may be considered as a voucher. An agreement or a contract or correspondence. Now let us say the auditors are appointed and you may not be knowing, but before the commencement of the audit, the company has to issue an engagement letter to the auditor. That engagement letter can also be considered as a voucher. So it's an agreement with the auditor that we are engaging you to conduct the audit in our organization. These are the fees that we are going to pay you. So it's an agreement. Third point is a resolution passed by the board of directors or shareholders. A lot of times it happens that, as we all know, that the board of directors must meet at least once in a quarter. So at least four meetings should happen. Board meetings should happen in a year. During that year, in that meeting, let us say the board of directors have appointed a new authorized bank signatory. Now the resolution passed by the board of directors is signed by them, and the resolution should contain the name and designation of the person who is appointed as the authorized bank signatory for the organization. Now if the auditor is checking the authorizations on the bank portal, they will check if whatever the authorizations are done by a specific person, whether the board of directors have signed the resolution to that effect or not. So a resolution passed by the board of directors is also called as a voucher. An invoice, as I had mentioned earlier, sales accounting entries would be booked on the basis of a sales invoice, whereas purchases are booked on the basis of a vendor invoice. So an invoice is also called as a voucher. Bank paying in slip. I mentioned to you that when we deposit a check, the big part of the the big part of the checkbook goes, the big part of the withdrawal slip, or no, not withdrawal slip, the pay in slip goes to the bank, and the small counterfile remains with us. That's a voucher. Bought note or sold note. So any sale register, purchase register, then any what we say, delivery challan of the goods, for the goods that are sent to, let's say, some warehouse. Gatekeeper books, wage books, order book, etc. So if the company is having some workers working on their shop floor, the wages that are paid to them on a daily basis, they are paid to them, signature is taken, and if required a revenue stamp is also affixed on the wage book. That wage book also is a voucher. I explained to you about different types of vouchers the auditor may check while performing audit of different functions of the organization. Now, as we have seen the different types of audit, we will see how the vouchers are examined by the auditors. Auditors, while examining these vouchers, they consider some points. The first of that is all the vouchers should be consecutively numbered and filled in order of their entries in the books of accounts. So it says that whatever vouchers the company is preparing should be consecutively numbered. So it should not happen that in Jan the invoice number 1 is issued by the sales team, and in the same month they have and the second invoice is and the invoice that is raised in Feb has a number 2. So in between there are different numbers on the invoices. It should not happen. So consecutively numbered invoices or documents or vouchers should be there. The auditor should pay attention to the date mentioned on the voucher. It should belong to the financial year under audit. As we all know that the profit and loss account of the company shows expenses and losses or incomes or gains for that particular period, that is from 1st of April of X year and 31st of March of the same year. So whatever voucher is prepared, the date of the voucher should be of that particular period and not for any previous period or not for any future period. The amount shown in the voucher should be calculated accurately and the amount stated in words and figures should match. So if you are depositing a check in the bank, if you mention amount as 1 lakh on the as the total amount, and in words if you write 10,000, there is an issue, and first of all bank will not accept it. Secondly, even if the bank accepts, the auditors will definitely raise a concern. Voucher should relate to the business of the client. If business of the client is of selling stationery, and if you see a sale of scrap, not scrap, we'll say if you see sale of machine, then it's a cause of worry, and the auditors are going to take this up very hard with the top management because it's not part of their business. The signature of the official authorizing the payments should be present. So before the starting of the audit itself, the auditors will ask the authorized signatories to sign on one page, and the auditors will keep that page readily available with them whenever they are checking the authorization of the vouchers. Special attention should be paid to those vouchers which are in the personal name of one of the partners, directors, managers or secretary, etc., as such vouchers may not relate to the business. Now let's say if an employee is being sent to some other location to carry out his responsibilities, and the hotel where that person stayed has raised an invoice or provided the hotel bill in the name of that person instead of giving it in the name of the company, then the auditors may raise a concern as to why the invoice is being taken in the name of the person who is staying and instead of name of the company. So it could be possible that that person had gone there to have some picnic with the family, but stayed and claiming the expenses in company, from company. So the special attention should be given to such cases. Eighth point is he should check to which account the payment is posted, that is revenue or capital. So it is possible that the majoritarily it is possible that the nature of transaction is capital, that is some asset has been bought by the organization, but it is booked directly to the expense account. So there is a loss of depreciation not being claimed by there is a loss for the company as the depreciation won't get claimed, and the profits will show higher amount, and that's the reason why the company would pay higher profits, or uh, it may show incorrect picture to the shareholders of the organization. So no capital expenses should be charged to any P&L account, expense account. Ninth point, if a duplicate voucher for a missing one is produced, it should be properly examined to avoid fraud. It is possible that the original voucher was prepared with some fraudulent intention, and just because the auditors are there, a fake or a duplicate voucher is prepared just to avoid further checking or for further inquiries. So if any duplicate vouchers are submitted to the auditors, then they should check those they should check those vouchers thoroughly. The auditor should not seek help of the client staff while checking. So while checking, the auditor should do that work independently. They should not call any person while they check. But yes, after checking, if they have any observations, those observations should be discussed with the person who prepared the voucher, who signed the voucher. And after discussions, if the auditor feel that the voucher is fake, if there is some error or fraud that they have detected, that should be highlighted to the management and should be reported in the audit report as an observation. Now let's look at different types of vouchers. First is primary and second is collateral or secondary voucher. Vouchers may be primary. It could be cash memos, rent receipts, agreements with vendors, wage sheets, etc., or copy of invoices for sales, copy of invoices for purchases. And in case of secondary vouchers, these are copies of the original vouchers and support the original voucher. For example, carbon copies of a cash memo, rent receipts, counterfoil of a paying in slip, etc. So for preparation of the voucher, if any calculation is done and that calculation is attached to it, then it becomes the secondary voucher. But the primary voucher has to be checked by and it should be in original. The secondary vouchers may not be in the original, but as those are just a supporting document to the main voucher. So with this, we will stop here, and in next lecture we will look at the vouching. Thank you.